Right now, companies are spending roughly $1.5 billion a day building data centers for artificial intelligence. Not a year, a day. That's more than America spent building the interstate highway system, adjusted for inflation, being poured into buildings full of computer chips, on a bet that AI will change everything. Maybe it will. But here's the uncomfortable question nobody can answer yet. What if the money is moving faster than the proof? Because that gap between money and proof has a name. It's called a bubble. And whether you own AI stocks or not, whether you can even name a single AI company or not, if this one pops, it will find its way to your job, your pension, and your savings account. So in the next few minutes, I'm going to show you what a bubble actually is. It's not what most people think. The 4 warning signs economists look for, how each one is showing up in AI right now, and exactly step by step how a burst would unfold, like dominoes. And by the end, you'll have 3 questions you can ask about any hyped market, AI, crypto, housing, whatever comes next, that tell you whether it's built on earnings or on hope. Let's start with the thing almost everyone gets wrong, what a bubble actually is. Most people think a bubble just means prices going up too fast. It doesn't. Prices going up fast can be completely rational. If a company invents something amazing and profits explode, the stock should go up fast. That's not a bubble. That's just good news. A bubble is something more specific. A bubble is when money starts chasing a story faster than the story can prove itself, and then the rising price becomes the proof. Let me show you what I mean. Imagine a bonfire. Normally, a fire needs fuel, real wood. In markets, the wood is profits, actual money earned by selling actual things. But sometimes a fire gets so big and so bright that people stop checking whether there's wood underneath. They see the flames and think, that fire is huge, it must have plenty of fuel. So they throw their money in, which makes the flames bigger, which convinces more people there must be fuel, which brings more money. The fire is now feeding on belief instead of wood. That loop. Price goes up, so people believe, so they buy, so price goes up, is the engine of every bubble in history. Dutch tulips in the 1600s, dot-com stocks in 1999. American houses in 2006. The story changes. The loop never does. And here's the cruel part. From the inside, a bubble and a genuine revolution look identical. Both have soaring prices. Both have true believers. Both have skeptics who look like idiots for years. So how do you tell them apart? You can't do it by looking at the price. You have to look underneath at 4 specific warning signs. Warning sign 1. Too much investment. The first sign is when spending on the new thing becomes so enormous that it stops making sense on paper. Here's the arithmetic for AI. The big tech companies, Microsoft, Google, Amazon, Meta, and their partners are on track to spend several $100 billion a year on AI infrastructure, heading toward trillions this decade. Chips, land, buildings, power plants, some data centers now use as much electricity as a mid-sized city. Now, spending isn't bad. Railroads cost a fortune too, and railroads were real. The question is the return. By most estimates, all the AI products in the world, the chatbots, the subscriptions, the business tools, currently bring in tens of billions a year in revenue, against hundreds of billions a year in spending. Picture opening a restaurant that costs $10 million to build, in a town where diners currently spend $400,000 a year on eating out. Could the town grow into it? Maybe. But right now, the building is 10 years ahead of the customers. When investment runs that far ahead of income, one of 2 things must happen. Either the income catches up, or the spending stops. There is no third option. Which raises the next question. If profits haven't caught up yet, what exactly are people paying for when they buy these stocks? Warning sign 2. Too high valuations. They're paying for the future, which brings us to sign number 2. A stock price is basically a promise about tomorrow, and you can measure the size of the promise with one simple ratio: how much you pay for the stock divided by how much the company actually earns. Historically, American stocks have traded around 15 to 20 times their yearly earnings. Pay $20, get $1 of profit a year. Fine. Some AI-linked companies today trade at 40, 60, 200 times earnings. A few are valued in the tens of billions while earning almost nothing at all. Is that automatically insane? No. Amazon looked overpriced for 20 years, and the doubters were wrong every time. A high price can be a correct prediction. But notice what a high price does. It removes the room for error. If you pay 15 times earnings and the company merely does okay, you're fine. If you pay 60 times earnings, okay is a catastrophe. You haven't just bet that AI succeeds. You've bet that it succeeds quickly, enormously, and without disappointment. At today's prices, pretty good is the new failure. Remember that phrase. It's going to matter when we get to the dominoes. Warning sign 3. Everyone owns the same bet. Sign number 3 is my favorite because it hides in plain sight, maybe in your retirement account. Ask around and most people will say, "Oh, I don't own AI stocks. Too risky for me." Here's the problem. The American stock market is dominated by a handful of giant tech companies, and those few companies now make up roughly a third of the entire S&P 500 index. That's the index inside most 401ks, most pension funds, most safe, boring retirement portfolios in America and Europe. So the school teacher in Ohio, the nurse in Manchester, the retiree in Berlin who's never typed a prompt in their life, through their pension fund, they own the AI bet. Millions of people are all in the same boat, and most of them don't know they've boarded. Why does that matter? Because concentration is what turns a stumble into a crash. If a bet is spread across thousands of small holders, bad news hurts a few people. If everyone holds the same bet, bad news hits everyone at once. And when everyone tries to sell at once, there's no one left to sell to. The exit door is the size of a cat flap, and the whole stadium is inside. Warning sign 4, borrowed money and money moving in circles. The last sign is the one that historically turns bubbles from painful into catastrophic. Leverage. Borrowed money. In 1929, people bought stocks with 10% down and 90% borrowed. In 2008, the housing bubble was built almost entirely on debt. When prices fell, borrowers had to sell, which pushed prices down further, which forced more selling. Debt is the accelerant. So how does AI score here? Honestly, it's mixed, and this is important. The tech giants are mostly paying cash, real profits from real businesses, search ads, iPhones, cloud services. That's genuinely different from 1999, and it's the strongest argument that this isn't a bubble. But look closer, and two quieter patterns appear. First, debt is creeping in at the edges. Hundreds of billions in loans and bonds are now funding data centers, often through private lenders where nobody outside can see exactly who owes what to whom. Second, and this one deserves its own diagram, the money has started moving in circles. A chip maker invests billions in an AI company. That AI company uses the money to buy the chip maker's chips, which the chip maker reports as revenue, which pushes up its stock, which funds more investments. Company A funds Company B, B buys from C, C invests in A. Each deal on its own might be perfectly sensible, but stand back and it looks like three friends passing the same $100 bill around a table, each one recording it as income. The numbers on paper grow. The question is how much outside money from actual paying customers is entering the loop. When revenue depends on your investors and your investors depend on your revenue, you don't have a market. You have a hall of mirrors. The anatomy of a burst. So those are the 4 signs. Now let's answer the question you actually came here for. If it pops, how does it pop? Not with an explosion, with dominoes. Watch the sequence. This is the same sequence as 1929, 2000, and 2008, just with new names. Domino 1, the trigger. Something makes cheap money disappear or breaks the story. Maybe interest rates rise, so borrowing costs bite. Maybe one quarter, a tech giant quietly says, "We're trimming our data center budget." Or an AI product everyone expected to be revolutionary turns out to be pretty good. And remember, at these prices, pretty good is the new failure. Domino 2. The spending stops. The giants cut orders, but an entire supply chain, chip makers, server builders, power companies, construction firms, was hired for a party that just got smaller. Their revenues fall short. Their stocks drop. Domino 3. The loop reverses. The magic circle from sign 4 now runs backwards. Fewer chip orders means less revenue, means falling stock prices, means less money to invest in partners, means those partners buy even fewer chips. Every handshake that pushed prices up now pulls them down. Same loop, opposite direction. Domino 4. Everyone heads for the cat flap. Fund managers don't wait around. Because everyone owns the same few stocks, sign 3, selling begets selling. And since those stocks are a third of the index, the whole market falls, dragging down companies that have nothing to do with AI. Domino 5. It reaches people who never bought in. Pensions shrink. Companies freeze hiring. Not just tech firms, but the electricians, truckers, and builders working on those data centers. Towns that bet on hosting them lose tax revenue. The nurse in Manchester opens her retirement statement and wonders what she did wrong. She did nothing. The boat she didn't know she boarded hit the rocks. That's the mechanism. No villain required. Just the loop, running in reverse. The honest part. Now, will this actually happen? Here's where I have to be straight with you. Genuinely smart people disagree, and both sides have real evidence. The optimist's case is strong. Unlike the dot-com era, today's spenders are the most profitable companies in human history, largely paying cash. AI usage is growing explosively. And even the dot-com crash, brutal as it was, left behind the fiber optic cables that gave us the modern internet. Bubbles can destroy investors and still build the future. The pessimists point at the gap between spending and revenue, the circular deals, the creeping debt, and one lesson from history. Every bubble had a perfectly good reason why this time is different. Sometimes it even was different, and the price was still too high. The railroads were real, and railroad investors still got wiped out in 1873. A technology can succeed while its investors fail. Those are two separate questions. So don't let anyone, including me, tell you the answer is obvious. It isn't. The point of this video was never to predict. It was to hand you the toolkit. The 3 questions. Here it is. Any hyped market, AI today, whatever comes next, ask 3 questions. 1. Is the price backed by earnings or by a story about future earnings? Stories can be true, but know which one you're paying for. 2. If this thing merely does okay, not great, just okay, what happens to the price? If the answer is collapse, you're not investing in a company. You're investing in perfection. 3. Where is the money actually coming from? Outside customers freely paying, or borrowed money and friends buying from friends in a circle? Earnings, room for error, real outside money. If you can answer those 3, you'll see clearly while everyone around you is staring at the flames. Because here's the one sentence to take with you. A bubble isn't when prices rise. It's when the rising price becomes the only evidence. If you're a beginner with decades ahead of you, this isn't a reason to hide from investing. It's the reason diversification exists. So no single story can sink you. If you're near retirement, it's a reason to actually open that statement and see how much of your boring fund is riding on 7 stocks. And if you're just watching from the sidelines, now you know why this story is about you too. One more thing. When bubbles burst, everyone asks the same furious question. Why didn't anyone stop it? The strange, unsettling answer is that some of the smartest people in every crash knew and kept buying anyway. Why they do that? Why knowing about a bubble doesn't protect you from it is its own story, and it might be the most important one in finance. If you want that video next, tell me in the comments. And if this one made markets a little less mysterious, you know what to do. Thanks for watching, and see you in the next one.